read-only mode.
Well, good evening, ladies and gentlemen. It's a few minutes past starting time, so welcome to this Daniel Code webinar, and thank you for being with us today. William in Honolulu again. Well, good to have you with us. How's the volume, folks? Here we are. Okay. What does Dean say? Can you hear me all right, Dean? Is the volume all right? Good. Keith, yes, thank you, Keith. He's on the job. Dean says, good evening. Great day to trade the grains or what? Absolutely amazing, isn't it? We've been blessed with wonderful markets. Thank you, David's with us as well. And Keith and Dean and lots of other folks as well. So let's get started. We've got an awful lot to talk about today, haven't we? Wow. Okay. Let's see what's what. Our Anthony's with us down in Sydney. We don't often have Anthony with us. Glad to have you with us, Anthony. Benjamin, of course. Thank you. Good to have you with us. Carol, welcome, Carol. Lovely to have lady members. We don't have many, but we love having them. Chris is with us. David over in New Zealand's with us. Welcome to all our friends across the ditch there. Dean up in the coal country, our super trader. Well, wonderful to have you with us. Donald as well. George Giggs with us over in North Carolina. And it's good to have you with us, Gig. I trust you are well and that you're getting plenty of time for your golf. Joel from Vero Beach is with us again. Thank you. Greg's a wealth fund manager in Colorado Springs. Great guy. And nice to have him with us. Jeff's with us as well. He's a tutorial guy. Jen's with us. John's with us. He's about to do a. I think he said he was in Arizona. John is about to start a Daniel Code tutorial next week. He's a forex trader, prop trader. Wonderful. Juan's with us. Great to have you with us. Keith, of course, we've said. Les, Mark, the other Mark L. Mark, the guy who's a very, very good trader. He's done the Daniel Code tutorial. Absolutely terrific, but he's apparently also a fantastic manager. So he's trying to retire, but he keeps getting offered new jobs. So he's very much in demand. Good on you, mate. That's good. See, Mark's with us. There we are. We got to there. Martin's there. Murph, of course. Always the Murph's with us. Wonderful to have you. Milton as well. Anthony, yes. Ned's with us. Nathan's with us. Peter Mack, he's the short-term trading guru. Scott's with us. Sean's with us. Suhasini's with us. Haven't seen you for a little while, Suhasini. I hope you're well. Hope everything's settling down there and you're getting back to your trading. She's a tutorial graduate. Wayne's with us, and of course William. Okay, so here we are. So Ben is in North Carolina. Two North Carolina guys. Yeah, right. Suhasini says she's doing well. Great to have you here, all of you. Okay, so folks, wow. As Dean was saying, the grains have just been absolutely sensational trading, haven't they? It's been wonderful, and there's a few others as well. So a lot to talk about today, and a lot to think about. Let's move along and get started. Here we are. Okay, so here we are. Markets we know are rational, orderly, and sometimes predictable, which is pretty interesting stuff. So let's start by having a look at this. Forex has been doing exceptionally well lately. I don't know, most of you may not know this. I actually started off as a Forex trader. When we started the Daniel Code website, way back, are you going to believe this, 2007, late 2007. Time flies when you're having fun. the emphasis was on Forex. Over the years, that sort of morphed. I've become personally more interested in futures, but I still trade Forex, and you can see why. Have a look at this. This is the Euro-Japanese yen, and I want to be making this point to you again about target recognition. The one thing the Daniel Code has that nobody else has are the Daniel Code ratios. And these ratios, which are actually time cycles, but we use them for price, because time and price are the same thing on different axes. But for those of you who've done a Daniel Code tutorial, you'll know where these ratios come from and how we get them. And they are time cycles, which we then use not only for time cycles but also for price. And look at this for accuracy. Here's our TO3 buy signal. Boy, the TO3s have been doing so well. It's a terrific service. So have a look at the big bar up, which was Tuesday, 27th. And that's the one, the first one, as we rise, saying this is DC target recognition. Have a look at the close of that bar, 131447. There's the Daniel Code number, 131468. A handful of ticks different. The next day, you also get target recognition. The close of that bar is 131689. The Daniel Code number is 131659. Then we get today's bigger bar up. Look where the high was. Remember, target recognition is valid on the bar high low or on the close. This market is rallying, so we expect to see target recognition either at the high or at the close. And the high of this bar is 132367. There's the Daniel Code blue line, 132385. Been on there for many days, maybe weeks. And that's the great difference with the Daniel Code, that the target recognition is the thing that gives you the setup for Forex signals, and it doesn't happen anywhere else. It's completely unique, and the Daniel Code ratios are not fib numbers. They're not old highs and old lows. They're like nothing you've ever seen before. As proof of life, on the Daniel Code website, for those of you who are new to us, we have a link that says Chart Archives. And under that link, there's over 40,000 Daniel Code charts that I've created over the years, and you can look through them. You'll be hard-pressed to find a market that's ever turned anywhere except at the Daniel Code ratios. Now, occasionally, and by occasionally I literally mean once or twice a year, and remember, we're covering 30-odd, 26-odd markets. Once or twice a year, markets will slip off their daily DC numbers and they'll go on to a shorter time cycle. And it's literally once or twice a year. And when that happens, you'll see I'll post on the chart turned at a ratio that was not on your chart. And sometimes it'll switch to a 720-minute or a 240 ratio. All the ratios are there, but the dominant ratio is daily bars, true highs, true lows. And that's what creates these numbers. And they're extraordinary. It just goes on and on and on. And that's the big thing to think about. I want to also just raise a point that I've been talking to you about. Let me just catch up here where I am. I've been talking to you about recently, and that's these failure signals. So this is actually dollar CAD, US dollar Canadian dollar pair. And this is a really, really nasty trade, because you had your TO3 plus buy signal on Monday, April the 19th. You can see the little arrows on there. Pointing it out. That trade was elected, up it went, and a pretty decent move up. If you thought the trend had changed to up, it was a reasonable assumption from the size of that bar, and you held that trade. Well, the next day, it hit the Daniel Code red line at 26.50, stopped like it was shot, and plummeted, gave back all those lovely gains. But the point I'm making is, if you just keep your eye on that bar of April the 19th. That's the one that's got the arrow on it saying TO3 plus a buy. Because that's the setup bar for a Daniel code buy signal, it has a failure point. All Daniel code signals have a failure point, and that failure point is, this is Forex, so it's 5 ticks, but it's literally 1 tick. We add a buffer of 5 ticks when we're trading Forex, because true highs and true lows in Forex can differ slightly across platforms, because there's no central exchange for Forex. So the numbers you get on your chart come from the data provided by the supporting banks, and they can be a few ticks different. So we use a 5-tick buffer. Let's say you add 5 ticks to the buy point, the true high, and take away 5 ticks from the low point, which is the true low. But once you've had a Daniel setup bar like that one, the failure point, technically it's just 1 tick below. I've actually put this number on 2 ticks below, but at 12471, that's the failure point, which means if the market gets there without anything else, not a sell signal, market just gets to the failure point, means you're wrong and it should be the other way. So that was the point. You'd have been stopped out anyway earlier, but that's the point to have sold, because it's breached the failure point. And then you can see you've got a decent run down all the way down to 12274, which is not on your charts. Incidentally, that's a new number that was created today. It's not on your current members chart, so make a note. 12274. The next number down is 12248, and I'll try and get an updated chart posted later today. But I've talked to you about this for the last 2 or 3 sessions we've had. Be aware of failure points, because they offer you a marvelous new trading opportunity. Okay, so let's keep going here. Where are we up to? And here we are. This is Canadian dollar, Japanese yen. Forex just been doing terribly, terribly well. I don't know, we've got a lot of Forex traders, but we just, at the moment, boy, the Forex trading has been quite fantastic. This was one I think that I wrote about on the front page, and look what's happened to it now a few days later, $2,000 per one contract, and it's found its blue line perfectly. You don't have this particular chart. This is not one of the ones that we post for members charts, but as you can see, the ones that we don't post in members charts, I'm doing those charts anyway, as you can see, and you can see what a lovely setup we've got sitting right here, that you've got almost perfect target recognition at that 88676 number, and pretty close to target recognition at the high, and I've seen a bit of that lately. Markets are just so locked on the Daniel codes that often bars will give you a high that's target recognition, and the close that's also target recognition. And just as the CAD-JPY that we looked at earlier, these markets often just go on hitting a Daniel code number, hitting a Daniel code number, so precisely to be hardly true. In fact, you know, if you didn't see it and see it for years and years, honestly, you wouldn't believe it. And nobody is more amazed by this wonderful thing than I am, that with all the drama, turmoil, whatever else is happening, nothing's changed. And I've been trading for over 28 years. The Daniel Code website's been public for 14 years almost, and you can see as much evidence as you like. This is what markets do, and you're only going to see that on the Daniel Code. Okay, so the topic here was the commodity super cycle is on us, and as you can see, this is the Goldman Sachs Commodity Index. This is a very long-term chart. This is 24 days to each bar, and you can see that the commodity index, which comprises groups of commodities all weighted variously. Have a look at what am I missing here? That's right. Have a look at how this thing's jumped, and it all started in May 2020. That was the low, and there's a lot of chatter about this. So I've called this the commodity super cycle a little bit with tongue-in-cheek, as you're going to see as we go through, because things are not always as they appear, particularly in trading. But anyway, here are some of the charts to look at. Dean's a farmer up in the really cold country, up in Canada. He's a gun trader. And interesting story with Dean. He actually did a Daniel Code tutorial way back, maybe, I don't know, we're talking 2010, 2011, sometime around there. And he did a Daniel Code tutorial at Colorado Springs, and a live tutorial. And he tried that, didn't quite work for him. He persevered, and he came back a couple of years ago and did another tutorial, which of course by now we've added teaching trading time, which I wasn't teaching when Dean did his first tutorial. And since Dean's been trading time, he's blowing them away. For those of you who haven't heard this story before, Dean doubled his account in August last year, got in 1 month, double the whole account, got 80% on his account profit in September last year, and this year he's doing very, very well, but he doesn't want to tell me how well he's doing because he says it will be boastful, and Dean is a modest gentleman. So if you get it right, that's how good you can be doing. And of course a lot of that is market selection, and these brains have really just been giving the gift, haven't they? Wonderful. So here's a 24-day chart of what corn's been doing. It's been roaring. Incidentally, look where it closed, right on that 643 carat 4 blue line and the red line, almost exactly target recognition on all time frames. Iron ore, another commodity, is at an all-time high. Iron ore is very, very important to Australia. It's the single most important export that we have, and it's at an all-time high. And it's holding the fort a bit because Australian government asked for an investigation into the origins of COVID and the Chinese lab, and the Chinese got very, very upset with us over that. So as well as that, the government, being part of the Five Eyes group, a lot, which is an intelligence and gathering group, been going since the Second World War, United States, UK, Australia, New Zealand, and Canada. They're the Five Eyes group, and as part of that, Australia banned Huawei from that contentious app that they developed, or program they developed in conjunction with the state, US and Britain, and of course China got very cross. So they've stopped taking delivery of Australian coal, which was a huge export market for Australia. There are literally hundreds of ships sitting off the Chinese ports, can't unload. China decided it won't accept that coal. They put a 200% tariff on all of our wines, which means Australian wine sales to China have dropped by 90%. They've banning Australian lumber, barley, all sorts of other imports. So China's very displeased with us, but they're still buying the iron ore. Now, the point here is to tell you that iron ore as a commodity, like the other commodities we're looking at, is at an all-time high. I had a couple of charts of iron ore, but they were a bit messy, so I left it at that. Here's gold. It's made an all-time high in August last year. It's come off a bit now, but only modestly. It's still very, very strong, like all the commodities. Here's Dr. Copper. Have a look at this. This copper market, he's referred to as Dr. Copper. For many years, people have named it Dr. Copper because it purports to tell the health of the nation due to the many uses of copper. Well, you can see what this has done since March 2020. So all of this looks like a serious commodity super cycle, doesn't it? Here's beans. I know Dean would have been all over this. We've been all over this with success as well. As the TO3 and plus signals, it's just been terrific trading. So have a look at this thing. It's rallied nearly $40,000. Wow, terrific stuff. Wheat, the same. Wheat's rallied up. Look how it's closed right on one of the DC red lines there. Same thing, same thing. All of these commodity markets are rallying, and they're rallying in important ways, and this rally's all started around February. This one started earlier. This is coffee. It came off its low in May 2019. Most of the other markets started their rallies in around February 2020. However, have a look at this chart. This is the same chart you just saw, but there's more data in it. So always be careful with charts. We don't spend enough time looking at really long-term charts. So the chart I previously showed you right there says, wow, that's a pretty impressive looking rally in coffee. And it is, but add in a bit more data and it puts it in perspective. That the price of coffee, yes, it has rallied pretty well, but compared to historic figures back in 2010, 2011, it's barely scratched the surface price-wise. Here we are. This is the Daniel Code T-bonds chart. I've showed you this chart many, many times, and it's an amazing chart. This is a slightly different one. What I've done is I've added in the heavier blue line so you can actually see it. Normally that's just a small dotted line. It's a bit hard to see. The heavy blue line, that's the median, and you can see amazing. This is we actually stopped this chart. Don't know if you can quite see the break, but we stopped this bar on this Daniel Code trading channel back in about here, back in about 2011, maybe a little later. Oh, here it is. You can see, I think. Yeah, I think it's in here. I've added the blue line. It should just become a dotted line there, but it was hard to see. But have a look what this thing's done. From that blue line, which is the median, interesting way of looking at charts, this, because when you're looking at angular charts, which is what these are, then these lines, or the price lines that appear to be price lines, are actually angles. So they have qualities of time and price in them. And look how amazingly accurate this thing is. Hits that exactly 1, 2, 3 standard deviations above the mean. Down it goes, finds support, 2 standard deviations below the mean. Then it collapses all the way down, 1, 2, 3, 4, 5 standard deviations below the mean. Then it rallied up to here, 1, 2, 3, almost exactly 3 standard deviations from the mean, and look where it is now. It's fighting really, really hard to hold support, and this is 1, 2, 3 standard deviations below the mean. Okay, remember Newton's law, 1, 2, 3. Every action has an equal and opposite reaction, 1, 2, 3, and it's really struggling to hold this number. If this, interesting, isn't it? In the way these charts are, the yield is inverted. So for the T-bonds chart, the chart pointing going down means yield, interest rate is going up. And this yield has come off. This has come off quite a long way, hasn't it? It's come off in total 6 of these standard deviations. Now, these are not mathematical deviations. These are Daniel Code standard deviations. And that's why they fit so perfectly, because they're created by the market. But this liquidity, the Fed just had a meeting, promised endless liquidity forever, pretty much. And I think that's going to be an issue. But we shall see. Let's move on and see what else we can see. So let's have a look at the laggards. So crude oil is a laggard. It's had a pretty decent rally now, hasn't it, since April last year, but it hasn't really made much impression. It's still only picking off. It's only it's only correcting the minor rally at this stage. Here's natural gas. This is the futures contract. And natural gas, this is a US anomaly. International prices for natural gas are near $14 to $16. But in the US, this is the futures contract. They're down around $2 and a bit, $2.20 up to $3, $4. And that's an anomaly caused by historically the fact that export of natural gas in the US has been very, very limited. It's starting to free up a bit now, but nothing like the major producers, Qatar and Australia, massive producers of natural gas now. So we're looking at now at, you might have got the message when we looked at these, all of these commodities. What's the one thing they all had in common? We've looked at grains, we've looked at iron ore, we've looked at copper, some metals, we've looked at lots of things. What's the one thing they have in common? If you think about it, the one thing they have in common is they're all priced in US dollars. So let's have a look what the US dollar's been doing. This is the dollar against the loonie, the Canadian dollar. And as Terry said to me yesterday when he saw the chart, ouch, if you're Canadian, the loonie's worth less and less all the time against the US dollar. This is the Aussie dollar against the US dollar, which is actually showing you the same thing, but it's in the inverse because the Aussie dollar comes first. If you had it saw a USD AUD chart, flip it on its head, it would look very much like the Canadian dollar has. This is Aussie dollar strength, but it's not really Aussie dollar strength, it's US dollar weakness. And that's a very, very important thing to what's happening now, as you'll see. So let's keep with it. Here's Euro with the USD, same thing again. Euro strength, dollar weakness. Now, here we've flickered the S&P. This is the chart a lot of you were asking for at our last session, which Greg's son knows that it was a fortnight ago. And apparently fortnight is not an expression that Americans use a great deal. It's probably a British expression. We use it here. I use it all the time. Pretty normal. And a fortnight is 2 weeks. It's an abbreviation of 14 nights. So a fortnight is 2 weeks. And a fortnight ago, Greg, the wealth manager from Colorado Springs, his son picked up the fact of what a fortnight was. But have a look at this thing. I mean, again, look at that blue line. I've extended it. You can see where we stopped it. It's actually stopped back here. We haven't moved it since here we are, so sometime mid-August 2017. That's when we stopped creating this Daniel Code trading channel. But I've added it in here manually for you just so you can see. Look what's happened from here. Look how perfect this thing is. Hits the channel, dives down, rallies, dives down, hits the channel, hits the median, rallies, rallies, rallies up 1 standard deviation from the mean, corrects, just goes down, just breaks 2 standard deviations and reverses. 2 standard deviations below the mean, look where it goes to here, 1, 2, almost 3 standard deviations above the mean. And it corrects 1, 2, and a bit. Probably the same as this, 2 and a bit. It's a little bit better. Look what's happened now. Here this rally goes up here. This is a very strong rally. 1, 2, 3, 4 standard deviations. 5, in fact, by counting 1, 2, 3, 4. That's at the end. So there's 4 where we're talking about here. 1, 2, 3, 4 standard deviations above the mean. Then we got this February, March correction. Last year. 1, 2, 3, 4, 5 standard deviations below the mean. Now look what's happened. It's up 8 Daniel Code standard deviations from the mean. And it's been battling that resistance. You think these angle charts are not real. They just stop these markets like they're shot. They're very, very precise and extraordinary. But this market is so overbought that words fail me. And that is not a condition that happens to me very often. Hard to say, words fail me. This is natural gas. I put a little post up on the homepage a week or so ago saying keep an eye out on the expiration of the 50-day cycle. This is natural gas responding to that. You can see it put its high on the 29 days. This is a daily chart, and now it's then put in a second high on the 37 days. And the red line, you can see that angular red line, that's a fourth seal line, and it's struggling. I mean, it's really struggling to get above that. In fact, that's actually a fifth seal line. What is the fifth seal line? A fifth seal line starts from, in this particular case, it starts from a low before the low, and it intersects a swing low. Here it is. This is the swing that it's intersected right here. And then look where it goes from there. It finishes up from there. It became support for the next move down. It becomes resistance for this little rally here. Look where this rally went to, right at these numbers on the perigee. And this recent high we've had on the 29 cycle in the NASDAQ, that stopped it right there and then. Very interesting stuff. But what have I said there? I've called that. This, folks, is a huge error. This is what happens when you're doing this stuff at 3 o'clock in the morning. Do forgive me. It says natural gas. This is the NASDAQ chart. What I'm trying to show you is the differences between the Russell, S&P, NASDAQ, Dow, and Germany's DAX, because the normal position for these major equity markets is that they are in sync in direction, if not in quantum. And recently, they've fallen out of sync, as you'll see. Here's the NASDAQ, made its high, tried for its second high, failed. This one here is the NASDAQ. It's the is the NASDAQ. It's the same thing you just saw. Made its high on the 29. That was that 50 cycle expiring, and again at the 37-day, and it's struggling for direction. This is the Dow. Sideways, sideways, sideways. This is the S&P. It's broken through its it had major resistance up there. You can see, ignore today's bar, go back the last 1, 2, 3, 4 bars. Boy, they were all just bouncing around the blue lines there, the Daniel Code blue lines. It's broken through today. And here's the Russell. And the Russell is, it's been below its low, but below its highs for quite a while. The Russell 2000, this is the small caps market. These are 2000 markets on the New York Stock Exchange Index, New York Stock Exchange bourse, I should say, but they are, Greg, looks like we have a NASDAQ chart. Stephen, I think you were looking at the NASDAQ. Yes, I was. My apologies, guys. But you can see that all of these equities markets seem to be at different points, don't they? Here's Germany's DAX, which is usually very highly correlated with the US markets, and it's broken down to the downside today. So these markets are not in sync. It seems to me it's almost as if the market is searching for a narrative which will allow this rally to continue. But I think there's considerable risk in these equity markets at the present time. Let's have a look at this. As we've moved now from the onto the DAX index, and this is one of the angular charts for the DAX. Same thing, you can see from where it started. First rally up goes exactly to 1 standard deviation from the mean. Then it drops down, doesn't quite get to 2 standard deviations. Goes along further, it runs up to 2 standard deviations above the mean, and then it goes down 2 standard deviations below the mean. That's perfect. The next big rally takes it 1 standard deviation above the mean, and then 1, 2, 3 standard deviations below the mean. Look where it is now. It's struggling to get back to the mean. That's where it is right now. That's the extension of the blue line. That's the mean. If you look at these angular charts, they give you a completely different read on individual market strength. And this one, frankly, looks very impressive, and it is. It's been a great long trade, but it's struggling. We're moving back now down to a 12-day chart to show you the same thing that we talked about last time on the S&P. Look where it is, right at that. Well, where are we? 1, 2, 3, 4, 5, 6 standard deviations above the mean on the 12-day chart. Same thing. It went down. The February-March last year correction was 1, 2, 3, 4, almost 5 standard deviations below the mean. It's now at 1, 2, 3, 4, 5, 6. So there's an overbalance for you right there. Does it matter? Everything matters. Is it a timing signal? No. It simply is what it is. This market is very overbought, and it's finding substantial resistance where it is now. Let's have a look at this supposed great commodity rally. Have a look what's on the other side of these markets. Remember I said to you, what have all these markets got in common? What's the one thing they all have in common? They all are commodities that are priced in the US dollar. So let's put them on the chart. So this chart here shows you soybeans on top, DX, the US dollar index, on the bottom. The DX, the US dollar index, is a basket of currencies weighted according to their trade relevance with the United States. Have a look what's happened. Soybeans has gone up, US dollar has gone down. This is coffee. Coffee has gone up and down and up and down, and it's pretty well matched in the inverse what's happening with the US dollar. We had a big run down in the dollar, good rally in the coffee. Little rally up in the dollar, sideways in coffee. Little poke down, 1, 2, 3, 4, 5 bars down. Remember, this is a 3-day chart, and you've got exactly the same in coffee, 1, 2, 3 up. Look at this latest run. They tried to merge coming together. That means weakness in coffee, strength in the dollar. Then that reversed. Look what's happened. Dollar down, coffee up. In other words, I hope you're starting to see that this commodity rally is really a result of the weakness in the US dollar. Because as the US dollar gets weaker, prices increase to try and keep regular relevant parity in between. And I'm showing you a number of these charts to show you this just goes on and on and on. And this is the sort of behavior we typically expect to see in gold. Gold has periods where it is inversely correlated with the DAX, with the US dollar index, the DX, I should say, the US dollar index. That sort of behavior we expect to see in gold. But look, we're seeing it across all of these commodities. Same thing here. Equally as dramatic. Big belly down on the US dollar index. Nice big rally up in copper. Second bite at the cherry. For a few weeks there, maybe even a few months, it went the same way, but it switched back. And look at this last period. 1, 2, 3, 4, 5, 6, 7. That's almost a trading month. 7 3 is 21, normally 22 days, trading days in a month. As the dollar has collapsed further, the price of copper has gone up. And this is gold. This is what we expect to see normally. Gold changes its habit from being inversely correlated, that means doing the opposite of what the dollar's doing, to its other position is being with it. Look what's happening just at the end of gold. We've just been seeing this again. This is a 3-day chart. No, this is a daily chart, full-on daily chart. Here's the last 1, 2, 3, 4, 5, 6, 7, 8 bars down as the dollar has gone down as well. In other words, its basic behavior so far this year has been inversely correlated. The last week or a little longer, it's directly correlated. Gold's going down and the dollar's going down. Whenever there has been a break of the inverse correlation, traditionally and historically, it's been in favor of gold. So you may see a decent pop in gold anytime soon. This is sugar. Why am I showing you this? Well, I'm trying to make the point that the commodity super cycle is, well, yes, it's, Suhasini says inflation. Wow. This is massive, massive asset inflation, and commodity inflation is massive. And I sort of chuckled to myself last night reading some of the comments on Biden's State of the Nation, their speech to Congress, that people are saying or commentators are starting to say, with all that spending going on, we're frightened that inflation will rise again. It's an absolute load of rubbish. Domestic inflation has been running at about 14% for at least the last 5 years. The way that inflation is calculated for official figures is totally phony, and it just simply deletes the most volatile parts of that equation. So if you haven't noticed that your dollar's not going as far, and this is a common problem. It's Australia, New Zealand, Canada, America, England, everywhere, that all the Western world at least. If you do the shopping, you've noticed that you're spending more than you normally would. If your wife does the shopping, she's saying to you, this thing's cost a lot more, and it has. And it has, because we've got massive, well, it's deflation of the US dollar. That's what's doing it all now. The policy of deflation of the US dollar has been in place for a while. Trump was a big one for trying to delay or delay, to drive down, perhaps a simple way to put it in simple words, before I start stuttering like Mr. Biden. Trump, of course, being a mercantilist, all of those export people with export businesses love the currency to be cheap because it makes your goods more attractive for export. By the same token, it makes imports more expensive, and this is quite remarkable to see sugar. The inverse correlation between sugar and the US dollar is extraordinary, and it's just as accurate as can be, isn't it? And it's been doing this for a while. Okay, so the coming storm. Finally, we have to talk about what's coming, and this is the thing that worries me. Let's make sure that chart has changed for you, so we're looking at the right one here. Yes, we are, yeah. This is S&P E-mini, and this is a 3-day bars. Each of these bars is 3 trading days. You remember February, March last year, all the drama about COVID. It had been coming for 4 or 5 months before that, maybe 6 or 7 months. It didn't matter, it didn't matter, it didn't matter. All of a sudden, it mattered. Now, the carnage that COVID has wrought is absolutely extraordinary. It's almost unimaginable. Over 530,000 people killed in the United States. The world's most advanced technology, the world's most advanced health systems. 530,000 people dead. UK, just as bad. Europe, just as bad. Now it's just playing absolute havoc in India, which of course doesn't have the resources of the Western countries. But, you know, I mean, the New York, their whole medical system was overrun by this rotten thing. Same in the UK. It's been a terrible thing. And my question is, there's the first big reaction we had when finally the penny dropped, that there's a real financial cost to COVID. COVID matters. Well, then it did this miraculous reversal, the shortest bear market in history. We loved it. I think we got $42,000 in the 3 Daniel code signals in that drop down. And we had time exactly at the high. You've got those of you who haven't seen that, go back through the posted webinars. We talked about that a lot while it was happening. But look what's happened since then. What is this chart saying to you? Is it saying that COVID doesn't matter? Is it saying there's no financial cost to COVID? Because to me, that just flies in the face of reality. So it's that reaction back last year that worries me, and the way it's been overcome by sheer liquidity. The Fed is just pumping billions and billions of liquidity in. All sorts of different strategies and purchases of securities that you wonder what business the Fed's got of doing that. But nevertheless, that's reality, that's what's happening, and that's what worries me. I think eventually there's going to have to be some recognition of the debt issues we're having. So all countries are piling on debt as they deal with COVID, and they try to reduce or soften the effects of it. Revenue from tourism collapsed. All sorts of trading situations are now restricted. GDP is being hammered. Now, what happens in the US matters to all of us. So why am I always concerned about what happens in the US? Because as goes the US, so goes the rest of the world, at least the Western world. And that's the reality, that the US economy is just so massive that if we can see what's happening there, you can bet it's going to be happening more extremely than that in little tiny countries like Australia and New Zealand. So yes, US matters. Now, the debt, this question of the national debt, I don't think anyone's got a clue what it is, but most recent US presidents are guilty. No one's particularly to blame for this. Obama almost doubled the US national debt single-handed, was incredible. Then we got Trump, who, despite promising to be responsible financially, wasn't. He was a big spender. And the only thing that controlled more massive spending by Trump was the animosity of Paul Ryan, and Mitch being at best lukewarm. For those of you who remember, at the start of, near the end of Trump's interaction and quest for to become the Republican nominee, he made some comments that got a lot of press coverage. They were old comments, but they got blown up. And Paul Ryan said he wouldn't vote for him. He was the Speaker of the House, for goodness sakes, Republican. And Mitch McConnell, Mitch, very much a traditionalist. He's involved with his legacy, the history of the Senate. But you had, when Trump got that hallowed position of Republicans having the White House and both houses of Congress, it was pretty hamstrung because of Paul Ryan in particular. So a lot of the big ideas didn't get done. So just contrast that with what's happening now. Joe Biden couldn't poll better than 4th place in the Democratic primaries. I watched them all. It was embarrassing. Maybe he hit 3rd a couple of times, but as often as enough, his name wasn't even on the list. Kamala Harris, same thing. Couldn't get 1% of the Democratic primary. Now, they're the President and Vice President of the United States, because then came South Carolina, and Obama took over. And all sorts of deals were done and things were said. The reality being that Obama argued that Joe Biden was the only one of the then candidates, remember, included Elizabeth Warren, Mayor Pete, all sorts of other people. Obama argued that Joe was the only one who could get the black vote. And he was right, and he did. And I told you back then what we would get would be Obama version 2. But Biden is a better parliamentary operator than Obama. Remember, Obama was a comparatively new senator when he ran successfully for the presidency. Joe Biden's been a senator for 4 decades, and he's been vice president for 8 decades. He is an absolute master of getting legislation passed, and he really understands that historically governments lose votes in the midterm after a presidential election. That's been the historic pattern for ages and ages. And unlikely as it seems, the Republicans, the Democrats, I should say, rather, in the House of Representatives, they don't have many votes, many seats they can afford to lose. They lost a lot of seats in the last election. And there's not there's huge margins now between Democrats and Republicans in the House. And midterm reversals, lose a few of those seats, all of a sudden you've lost control of the House. And that's exactly what happened to Trump and pretty much to Obama. That's the historical pattern. But Biden's smart. He understands what makes the business of governing work better than anyone. He's been at it all his life. And he understands that he's got a small window while he has control of the White House and the House of Representatives and the Senate. And he intends to use it. You saw from the address to the nation yesterday, boy, talk about big plans, talk about big money. What's the total debt going to finish up like? We have no idea of what the total debt is. At best, we've got some sort of idea about government debt, but the whole lot of that is off balance sheet as well. But it's the other debt, it's the corporate debt, it's the bank debt. Every time there's a problem in the markets, a serious problem, it involves banks historically. What was the dot-com crash all about? Well, eventually people woke up, they were valuing dot-com companies based on clicks or based on eyeballs. Eventually someone got the idea that you can't actually to make profits, pay dividends or pay off debt with eyeballs. That's what caused that crash. What caused the 2007-2009 crash? Mortgages, okay, same thing. Banks lending too much money irresponsibly, unknowingly, totally unknowingly in many cases, just cloud cuckoo stuff. What's going to happen to stop this historic bull market we're in? I can tell you it's going to be involved with debt, and it's certainly going to have banks up to their ears in it. And that's the next coming thing. So I want to just have a quiet word to you about the basics of time. I've had a few people talk to me lately about the fourth seal forecast for June 2021. And we certainly all owe Frank DB a huge debt of gratitude. He kept us all long all through 2020 and so far the same through 2021. And even in the February-March 2020 flash crash, the 23 days or 22 days of the bear market, he was saying at the worst of that, this is still only a correction. The market is going to make new highs and continue making new highs. But certainly a number of you have talked about his prediction, the forecast in the fourth seal of serious trouble in June. What I want to tell you is that the basics of time, expiring time cycles, they create support and resistance. Valid Daniel Code time cycles create a vibration. But the Daniel Code is mute on quantum, which is a fancy way of saying we don't know whether a time cycle will give us anything from a one-day counter trend to a whole new major trend, i.e. a bear market. But all of this analysis is done off 6, 12, and 24-day charts. We can't trade those charts because the risk on entry is massive, way outside anyone's parameters. We do need a Daniel Code daily signal to pull us into the trade, because it's only the daily signals, the way we trade at least, that are within reliable and reasonable risk parameters. So be aware of what the fourth seal said. Frank is now updating every week when he does his weekly updates. he's thinking about and commenting on his analysis, which you're all aware of. If you're not, please go to the Daniel Code website. There are 2 articles there, the 2 most recent. One's simply called 2020, the other's called 2021, and they're the analysis that Frank DB, who runs the Fourth Seal for me, it's the analysis he did in December 2019 and December 2020, respectively, for the following year. But let me finally say to you, you can't trade the forecast. You need to trade the market, not the forecast. That is not in any way to diminish the wonderful work Frank's doing. It may be that this market keeps on hitting all of the ratios he's set for it. He knows what is the pattern that he's referring to and looking for it to repeat. If it gets to the stage it's not following that pattern, he'll let us know straight away. So make sure you're getting the Fourth Seal S&P and paying attention to it when it comes out every Monday. We're going to have a correction at some time, folks, and whenever it is, you're going to have to pay a bit of attention to some downside risk. Now, this is the old slow-mo chart. This is something that a wealth fund manager or a hedgie may use. You can see it's pretty liberal. It's allowed some very serious corrections, but this has run the whole time, and you've seen it on occasions from, it seems to start in 2019. For that 2 years, there's only been 2 corrections. And one was fairly small in July 2019, August 2019, and the other one, of course, was the biggie, the 23-day flash crash bear market, and you can see how this performed. We're going to get this up on the website hopefully in the next week. It'll be initially free for everyone to have a look at it. What does one say? We're in a new birth. We're in a new universe. Yeah, I think we are one. I think that's right. So this for those of you that have very long-term investments, hedge fund, wealth manager type funds. We're going to make this available on the website sometime next week. Terry is getting home, I think, on Sunday. He's been down in the States for a couple of weeks, but he's getting home to Canada. I think he said he was going home on Sunday, and then he's got to quarantine again because most of Canada's in lockdown. Anyway, he'll have time to get this up on the chart. So that's the this is slow mo. I call it that. It's like slow motion to me. I trade a lot faster than this, but it's the sort of thing wealth fund managers and hedgies need, and we're going to make that available. This is the chart I've been promising you for some time. This is on close for the S&P. This is a daily chart, but the signals are only red on close, which is entirely different because all the rest of our work is being done on chart bar high, bar low. This is entirely different. These signals are being created, same market, but we're only doing them on close. So it's pretty interesting, as you can see. It's had a couple of pretty nice runs through here, and where it's got for the fail there, I put an arrow so you can see those few days there where we had failure. The loss was not great, as you can see, but it's the best I can show you here. But by going to this on-close method of trading, yes, you are taking on more risk, and you need to be absolutely comfortable with that. And I'll probably do a special video about the risk management if you're interested in this sort of trading. But what it does, it gets rid of those damn one-day counter trends, which really are so annoying. 1 or 2 or 3 bar counter trend. They're just part of the game, but they're an annoying part of the game, and they keep been annoying me for many, many years. The whole point is that a signal that gives you a major trend change is in fact exactly the same as a signal that gives you a 1 bar counter trend. So you can't ignore it, but by moving to this on close method of trading, Yes, your risk will get bigger, but I'll do a video, give you specific ideas about how to manage that risk. But for the trader who likes it a bit more laid back, you only have to look at the chart on the close. All of these signals are created on the close, and numbers so far are pretty good. Okay, so folks, we're getting near the end of our time. If you'd like to do the sorts of things I do on these webinars all the time, we'd be happy to teach you. The Daniel Code tutorial teaches you Forex and futures. We teach you the very best of trading price, the very best of trading time, and Forex and futures trade almost identically. And we actually started pretty much as a Forex site, but it's grown over the years to have a lot of influence on futures as well. Some of you have expressed some interest in trading shorter time frames. I can show you the very best short-term trading methods that I have ever seen. I used to be a short-term trader, and I spent years of my life doing the all-night sessions, because in our part of the world, of course, when the US markets are open, certainly in RTH, it's the middle of the night over here. And I did years and years of it, trading short-term charts, some of them very, very short-term, like 3 ticks, if you like. But I certainly have a couple of the best short-term trading sessions, methods that I've ever seen. If there's any interest, I'll be happy to put together some sort of a tutorial, part of the tutorial, to teach short-term trading. Okay, so folks, if you'd like to be a super trader and learn to do this stuff, the greatest gift I can give you, it's also the greatest gift you can give anyone else. Financial independence, lifestyle independence. Make as much money as you want when you want. It's served me well. I've raised a family and 2 children on this stuff, and it's been wonderful, and I'd be more than happy to talk to you about the Daniel Code tutorial. Send me an email, please, jneedham@theDanielCode.com, and let me know you're interested in the tutorial, and I will send you some material, and we can have a chat on the phone about it whenever you wish. The business of trading futures and Forex is not to be right. The business of trading is making money. And that's something we're always very well aware of. So free trials, folks, if you haven't already, you're most welcome to have a free trial. Go to the Daniel Code website. Simply click on the link. The website is www.thedanielcode.com. Click on the free trial link. Follow the cues there. If you have any problems, contact Terry at support@thedanielcode.com. If you've previously had a free trial, the program will probably remember you, and you won't be able to go any further. But if you would like a free trial, you're most welcome. And if you haven't had a free trial for 6 months or so, you're welcome to have a free trial. Any problems, as I say, contact Terry at support. So big daily counter trades are demonic. I feel your pain. Yeah, Juan, I don't have any pain because daily counter trend trades are never less with the way we trade. Never more than 50% of ATR. So that's how we get the returns to be 2 to 1 or better. So other people feel pain, not me. Good. Akshay enjoyed it. Good. Thanks. Super webinar. Glad you liked it, Akshay. I hope you're safe, mate. You're in India. My goodness, look after yourself. It's pretty scary what's happening there. What's Greg say? Outside bars today. Ate my lunch. All good. Let's talk soon. I think we can probably get to talk to you on Monday. Greg, I'll let you know. Okay, Keith, glad you enjoyed it. Murph, of course, as always. Thank you for being with me, folks. It's Friday morning down under, and I put my orders on. I'm pretty much finished for the week. And I hope you enjoy your weekend and Friday's trading, of course, is still to go for most of you. This is our disclaimer, folks. I do ask you to take it seriously. I beg and implore you, do not risk real money trading until you are really confident that you know what you're doing. It's very, very easy to lose money. And once you know how to do it, let me tell you, it's very easy to make money as well. But you have to know what you're doing. And if you'd like to have that knowledge, let me know. I'll be only too happy to teach you. And that's us, folks. So that's us for today. Thank you for being with us, and good trading as we go. Good on you, Gig. He's enjoyed it. And this market's going to be pretty dynamic next week. All the best for now, and thank you for being with me. Bye-bye. Thank you, Martin, in particular, and you too, my friend. That's that. Finished for the day.